I could be twice as rich if I hadn't made one stupid mistake 50 years ago. This isn't dramatization on my part. It's simple arithmetic. Compound interest works both ways, on your earnings and on your stupidity. Now let me tell you something unpleasant. By the time you turn 50, most of your major life moves are already behind you. Your career trajectory is set, your family situation is what it is, and your ability to take wild risks has vanished. Unless you enjoy gambling with your pension, which is about as wise as betting your house at a casino. The truth is simple. After 50, you don't need brilliance. You need to avoid disasters. People love to talk about finding the next Tesla or striking gold in crypto. That is just noise. At 50, survival is the real game. I grew up during the Great Depression. I saw people lose everything, not because they weren't smart, but because they borrowed too much, trusted the wrong crowd, or thought the good times would last forever. This pattern repeats in every generation. The faces change, the stupidity does not. Here is my investment advice number 1 for those over 50. Play defense, not offense. You've already had your years of attack, your 20s, 30s, maybe 40s. That was when risk-taking could pay off because you had time to recover. At 50, time is no longer your friend. Most people don't understand this. They reach middle age and think they need to catch up. They pour money into some hot stock or get-rich-quick scheme. What happens? They go broke faster than they can say, pension plan. Let me illustrate. I knew a man, very smart, Ivy League educated, with a successful career. At 55, he decided he was falling behind his peers. He put a fortune into dot-com startups in the late 1990s. By 2002, he had less than half left. He spent the rest of his life talking about what he almost had. A waste of brains and money. The irony is, if he had just parked his money in boring, reliable businesses, Coca-Cola, Procter & Gamble, Johnson & Johnson, he would have been fine. Not glamorous, not thrilling, but fine. Sometimes fine is all you need. People over 50 often forget that the real enemy is not low returns, but catastrophe. Losing half your money at 60 is not the same as losing half at 30. At 30, you have another 30 years to recover. At 60, you might not even live another 30 years. It's not a fun thought, but it is reality. You have to switch from trying to be clever to trying not to be stupid. And believe me, avoiding stupidity is a full-time job. So if you are over 50, forget about chasing unicorns. Forget about trying to be the smartest guy in the room. The smartest guy in the room is usually bankrupt, divorced, or both. Your goal now is durability, endurance, having enough money to survive your mistakes. I often say, all I want to know is where I'm going to die, so I'll never go there. For investing after 50, all you need to know is what can destroy you, and then don't go there. This means avoiding leverage. Debt is poison, especially when you don't have decades to pay it back. Avoid speculation. You aren't going to outsmart a 25-year-old with 6 monitors and no personal life. Avoid complexity. The more complex the deal, the higher the odds that you are the patsy. At 50, your best strategy is to keep it boring. Boredom works. Boredom brings compound interest. Boredom allows you to sleep at night. The financial world doesn't reward excitement, it punishes it. So here's the paradox. The less exciting your investments are after 50, the more likely you are to enjoy an exciting retirement. Don't aim to get rich quick. Aim not to die poor. Envy has destroyed more portfolios than recessions ever have. People go broke not because they can't earn money. They go broke because they can't stand that someone else is earning more. I've called envy the stupidest of the 7 deadly sins. And I meant it. Why? Because it's the only sin from which you get no pleasure at all. Greed. You enjoy the spending. Gluttony. You eat. Lust. You get at least some pleasure. But envy. You just sit there and stew in resentment while the other guy enjoys his yacht. It's also contagious. If your neighbor buys a fancy car, suddenly you think you need one too. If your brother-in-law brags about a stock that went up 10 times, suddenly your stable investment with compound interest seems like a mistake. That is when the trouble starts. Let me give you an example. In 1990, Warren and I owned boring businesses: insurance, candy, furniture stores, newspapers. Nothing flashy. Meanwhile, kids in Silicon Valley, half our age, were making billions out of thin air. We looked stupid until the bubble burst in 2000. The same people who laughed at our slow investments were suddenly bankrupt. We were still rich. Here is the lesson. The game isn't about beating others. It's about not losing yourself. Envy makes you forget that. I knew a man who invested quite sensibly. Stable returns, decent savings. But then his golf buddies got rich on oil stocks. He couldn't stand remaining a small player. He took on leverage, chased the same deals. And when oil crashed, his portfolio crashed too. His buddies lost money too, but they still had careers. He had to worry about retirement. At 50 or older, envy is fatal. You don't have time to recover from your own stupidity. One envious move can wipe out a decade of patience. The best investors I knew cared almost nothing about what others were doing. They didn't care if the neighbor bragged about a hot stock. They didn't care if CNBC was shouting about the next big thing. They cared about staying solvent and quietly compounding interest. The irony is, if you want a happy old age, you should root for your friend's success. Envy makes you miserable when others are doing well. It's a terrible way to live. Imagine being 80 and still bitter that someone else has a bigger house. What a waste of life. I have outlived many people who were richer than me at some point, but I never envied them. I knew that most of them were playing games they couldn't win in the long run, and indeed, they burned out, or their money evaporated, or they drank themselves to death. Meanwhile, I remained boring, rational, and alive. So if you are over 50, here is advice you can take to the bank. Stop caring about how much others earn. Stop measuring your life by your neighbor's portfolio. Stop scrolling through financial gossip as if it matters. Envy won't make you richer. It won't make you smarter. It won't even motivate you. It will just push you towards stupid decisions. And remember, your pension doesn't care if someone else earned more. Your family doesn't care. The grocery store doesn't care. Only your ego cares. And your ego has bankrupted more investors than any bear market. So envy isn't just a sin. It's a bad investment strategy. Don't use it. I don't like talking about my mistakes, but they are more useful to you than my successes. Everyone loves hearing about winners. Few stop to study the losers. That is where the lessons are buried. Here is one of mine. A decade ago, I bought a stake in a company without truly understanding its future. On paper, it looked cheap. The numbers were clean. Management seemed competent. But I didn't think deeply enough about the business model. Result, I made a quick profit but sold too early. If I had the patience and insight to hold, that position could have doubled my capital. That's not hyperbole. That's math. Compound interest does not forgive early exits. The mistake wasn't the investment. The mistake was me. I lacked the discipline to hold on to a truly great business. I settled for being right in the short term instead of being rich in the long term. Most investors do the same thing. They sell winners too early and cling to losers too long. It's backward. You have to do the opposite. But it's hard. Human nature pulls you in the wrong direction. People love certainty. When something goes up, they want to lock in the profit. It feels safe. But selling Coca-Cola after modest growth in the 1970s wasn't safe. It was stupid. That stock continued to compound for decades. Anyone who sold early congratulated themselves while quietly robbing their future self. I no longer blame myself for this. Regret is wasted energy. But I use this memory to remind myself of one simple rule. If you find a truly great business, sit on your ass and hold it. Don't get cute. Don't get itchy hands. The world constantly tempts you to do something. Turn on the news, and you'll see endless reasons to act. Elections, wars, inflation, recessions. But most of that is noise. Good businesses survive. Great businesses thrive. Your job isn't to outguess every headline. It's not to sell the goose laying the golden eggs. For people over 50, this lesson is even more important. You don't have the luxury of making a mistake and waiting 40 years for compound interest to bail you out. One wrong exit, one poorly timed clever move can permanently shrink your nest egg. I see it all the time. Someone holds reliable dividend stocks for decades. Then they read a newsletter about some disruptor and decide to switch. They dump Johnson & Johnson and chase a tech IPO. A few years later, they wonder why their income dried up and their account is bleeding. The mistake isn't failing to predict the future. No one can. The mistake is abandoning what works to chase what thrills. Excitement is a terrible investment strategy. I could have been richer if I had learned this sooner. But at least I learned it. Many never do. They spend their whole lives jumping from one opportunity to another, while the boring investor next door quietly builds real wealth. So here is the takeaway. It's not genius that makes you rich. It's endurance. It's the ability to hold on when everything tempts you to let go. If you are over 50, you cannot afford to repeat my mistake. When you find a business that will still be making money in 20 years, hold it. Sit still. Don't sabotage yourself trying to be smart. In the end, the market rewards the patient, not the excitable. Remember, I became rich by consistently not being stupid, not by chasing brilliance. The older I get, the more I realize this. Most people are too confident, and the market punishes such arrogance sooner or later. I've been watching this for almost a century. In the 1930s, people were sure prosperity would never return. They hoarded cash and missed the rebound. In the 1960s, everyone was sure America's big companies would always grow at high rates. They ignored valuations and got crushed in the 1970s. In the 2000s, investors thought tech stocks would only go up. We all know how that ended. Confidence feels good, but it doesn't correlate with accuracy. In fact, I've seen the opposite. The people who sounded the most confident were usually the ones losing the most money. Here is the reality. The world is too complex for you to know everything. You don't get rich by being a know-it-all. You get rich by knowing what you don't know and avoiding it. When Warren and I were building Berkshire, We missed thousands of opportunities. We didn't understand them, so we ignored them. And guess what? We didn't miss much. The world throws a lot of pitches. You don't have to swing at everyone. But most investors can't resist. They think having an opinion on everything makes them smart. They'll tell you where oil is going, what interest rates will be next year, and how some new startup will revolutionize everything. What they don't tell you is that 90% of these opinions will be wrong. At age 50 plus, this flaw becomes more dangerous. You don't have the margin for error of a young gambler. If you throw money behind your half-baked opinion, the market won't forgive you. And unlike at 30, you don't have another 30 years to recover. I once watched a successful lawyer in Los Angeles, a smart guy with a good income, decide he was also a currency expert. He read a few articles, formed an opinion, and made a huge bet against the yen. It wiped out most of his retirement savings. Not because the yen was unpredictable, that's obvious, but because he was too confident in his ability to predict it. The irony is that if he had admitted, "I don't know," and left the money in something boring, he would have been fine. But people would rather be loudly wrong than wisely silent. Here's what I recommend. Develop the courage to say, "I don't know." It is a rare and valuable trait. If you can admit ignorance, you won't bet on nonsense. You'll stick to areas where you actually have competence. That is what we did at Berkshire. We understood insurance. We understood Coca-Cola. We understood See's candies. So we bought them. We didn't understand airlines or .com stocks, so we left them alone. That one habit saved us from disaster more times than I can count. Overconfidence kills more investors than recessions. It's not the market that ruins you. It's your illusion that you know more than you actually do. So if you are over 50, listen closely. Stop acting like an oracle. You don't need opinions on every sector, every trend, every country. You only need to know a few things well and admit you know nothing about the rest. In fact, I'd go further. The more confident someone sounds about the future, the faster you should run. Remember, the world is full of people eager to sell you certainty. Analysts, pundits, salespeople. They all sound smart, but none of them will pay your bills when their certainty blows up your portfolio. So next time you feel the itch to predict the unpredictable, stop and ask, what if I just don't know? That question could save your retirement. One of the biggest gaps I've seen in life is the gap between people who think like employees and people who think like owners. This has nothing to do with job titles or salaries. It's a question of mindset. Most people, even very smart ones, spend their lives playing career games. They optimize for raises, titles, and perks. They spend years sucking up to bosses they don't respect. They polish resumes instead of building wealth. That is careerism, and it is a trap. I have said many times, the world is not driven by greed. It is driven by envy. Careerism feeds on this. You watch the guy next to you get a fancier title, and suddenly you want one too. But titles don't compound. Ownership does. When Warren and I were building Berkshire, we didn't give a damn if we looked important. We cared about owning things that made money while we slept. See's candies, Coca-Cola, insurance companies. They didn't care if we were vice presidents of this or senior partners of that. They just sent us checks. Meanwhile, I watched brilliant lawyers, bankers, and executives spend decades climbing ladders. They earned high incomes, but owned nothing that worked for them. The minute they stopped showing up for work, the money stopped too. That isn't wealth. That's just a high-class treadmill. Let me give you an example. In my legal days, I worked side by side with some of the sharpest minds imaginable. They billed clients by the hour, made a fortune, and thought they were kings. But if they dropped dead, their income dropped dead too. They had nothing scalable, nothing durable. They were rich employees, not owners. In contrast, Warren and I directed our time toward creating ownership. We wanted businesses that didn't depend on our presence every day. That way, even if we were playing golf or were dead, the assets continued to compound. That is the difference. If you are over 50, this lesson is more important than ever. You don't have time to keep trading your hours for dollars. Eventually, your energy will fade. Your health will falter. The treadmill will stop. So ask yourself, do you own something that works for you when you are not working? Real estate that brings in rent, stocks that pay dividends. A share in a business that keeps earning regardless of whether you show up or not. If the answer is no, then you aren't really investing. You are just extending your career under another name. Careerism also clouds judgment. Employees think about how to please the boss. Owners think about how to survive reality. That is a huge difference. A career lawyer will do whatever pleases the partner. An owner asks, does this make money in the long run? Only one of these questions compounds. I will tell you something harsh. If you are over 50 and still living paycheck to paycheck, no matter how high that paycheck is, you have probably been thinking like a careerist for too long. You optimized your strategy for the wrong game. But there is good news. You can still pivot. Stop worrying about positions and titles. Stop worrying about what colleagues think. Care about ownership. This doesn't mean quitting tomorrow. It means redirecting your energy and capital into assets that will outlive you. Buy boring, durable businesses. Live within your means. Create equity stakes instead of spending money trying to look successful. It's a quieter game. No one will applaud you when you buy Procter & Gamble stock. But in 20 years, that stock will pay you when the applause has long faded. Careerism fades. Ownership compounds. Choose what will matter when you turn 70. If you lived through the Great Depression, you never forget it. I was born in 1924. By the time I was a boy, the economy had collapsed. Banks were failing. Businesses were closing. Families were starving. People today think volatility is when the stock market drops 10%. In 1932, the market fell almost 90% from its peak. That wasn't volatility. That was financial annihilation. I saw grown men lose their livelihoods. I saw families moving in together because they couldn't afford rent. My own family knew what it meant to save and stretch every dollar. It was grim, and it left an indelible mark on how I perceive risk. The biggest lesson: you cannot count on good times lasting forever. People today forget this. They think prosperity is the default setting. It is not. Civilizations rise and fall. Economies swing between feast and famine. If you live long enough, you will see both. The Depression taught me to respect reality. Optimism is wonderful, but blind optimism kills. Plenty of people in the 1920s thought the good times would never end. They borrowed money, speculated wildly, and leveraged themselves into oblivion. When the crash happened, debt destroyed them. That is why I have always despised debt. It makes you fragile. Without debt, you can survive bad times. With debt, Bad times kill you. Another lesson. Resilience beats brilliance. I saw small, boring businesses survive the Depression by being frugal and adaptive. Meanwhile, fancy operators with clever schemes vanished overnight. The survivors weren't geniuses. They were simply durable. This is a lesson most investors still haven't learned. Everyone wants to be clever. No one wants to be durable. And yet, durability is what gets you through once-in-a-lifetime collapses. I carried these lessons into my investment career. I don't try to predict recessions. No one can. What I do is assume they will eventually come and prepare accordingly. This means keeping a margin of safety. It means avoiding leverage. It means owning businesses that sell products people will keep buying in both good times and bad, like candy, soda, insurance. People mocked us for buying C's candies. How much money can you make selling chocolate? They laughed. Well, it turns out people eat chocolate during recessions too. They eat it even more. In fact, C's survived downturns that crushed flashier businesses. That is a lesson you only learn after seeing real hardship. Now, if you are over 50, you need to remember this above all else. You don't get a second Great Depression to relearn the lesson. If you blow up your finances once, you won't live long enough to rebuild. That is why you must structure your portfolio for resilience, not fantasy. When you hear people bragging about how much leverage they use or how genius their trading strategy is, remember 1932. Remember the breadlines. Remember the people who thought they were smart suddenly finding themselves in soup kitchens. The world has changed since then, but human nature hasn't. People still get greedy, still take on too much debt, still assume good times will last forever, and every few decades, reality punches them in the face. So my advice is simple. Learn from history you didn't live through. You don't need another Great Depression to understand the danger of stupidity. All you need is humility and memory. If I had to boil my so-called success down to 3 habits, it would be these. I avoided debt, I avoided drama, and I avoided stupid people. That's it. No magic formulas, no secret sauce, just subtraction. Let's start with debt. I've said it before, debt is poison. It destroys discipline. It magnifies stupidity. And it guarantees that when bad times come, and they always come, you will be the first to be wiped out. I saw people in the 1930s borrowing against their homes, thinking they were safe. When the crash hit, they lost everything. That image stuck with me. Warren and I built Berkshire without relying on borrowed money. We could have juiced returns with leverage, sure, but 1 or 2 wrong bets with debt, and we would have been bankrupt like everyone else. Staying solvent was more important than looking smart. If you are over 50, debt is fatal. At 30, maybe you recover. At 60, it's game over. You won't live long enough for compound interest to save you. Now, drama. I don't tolerate it. I avoided unnecessary fights, pointless feuds, and people who seemed addicted to chaos. Drama wastes energy. Energy that could be spent thinking clearly, building patiently, or enjoying life. Plenty of smart men were ruined not by bad investments, but by bad divorces, bad partnerships, or bad tempers. You can be a financial genius and still bankrupt yourself with personal chaos. I wasn't interested in that. And then there are stupid people. And by stupid, I don't just mean low IQ. I mean people who are reckless, dishonest, unreliable, or addicted to shortcuts. They are radioactive. Their stupidity spreads. Hang around them long enough, and you will get hit by the fallout. Early in my career, I saw colleagues get involved with slippery operators promising big returns. The script was always the same: fast talk, shady deals, inevitable collapse. The smart colleagues got dragged down just by association. I made it a rule. Better to have fewer friends and partners, but high-quality ones. My partnership with Warren worked for 50 years. Not because we never argued, but because we shared the same principles: rationality, patience, integrity. No drama, no debt, no stupidity. That made us durable. Most people underestimate how important it is to avoid the wrong things. Everyone is looking for the right stock, the right deal, the right opportunity. They ignore the fact that saying no is more important than saying yes. One yes can make you money. One wrong yes can ruin you forever. If you are over 50, this is not optional. You cannot afford to spend years untangling yourself from bad decisions. The margin for error is gone, so cut ruthlessly. No debt, no drama, no stupid people. It sounds harsh, but it buys peace of mind. And peace of mind is worth more than squeezing out a few extra percentage points of return. Remember, wealth isn't built by genius. It is preserved by discipline. And a big part of discipline is simply the ability to walk away from stupid temptations. People love to romanticize my partnership with Warren. They think we sat in some ivory tower playing chess with billions of dollars. Always in agreement, always brilliant. That is nonsense. What actually worked wasn't magic. It was discipline, temperament, and compatibility. And what didn't work, well, let's just say we made our share of mistakes, though fewer than most. Here is what worked first and foremost. We trusted each other completely. No backstabbing, no politics, no jealousy. That is rare in business. I didn't wake up worrying that Warren was plotting against me, and he knew the same about me. That trust gave us huge efficiency. Most organizations spent half their energy on internal nonsense. We didn't. We also thought about money the same way. We both valued patience, rationality, and independence. Neither of us cared about looking trendy or chasing Wall Street's approval. If something didn't make sense, we didn't touch it, no matter how many people laughed at us. Another thing that worked: complementary skills. Warren was a genius at finding undervalued businesses. I was better at reminding him not to get seduced by cigar butts, those crummy little companies you buy cheap and sell for a small profit. Together, we aimed higher. We bought quality businesses at fair prices and held them. That shift was worth billions. Now, what didn't work? Well, for one, we weren't perfect judges of people. We occasionally backed managers who turned out to be crooks, fools, or both. You can't filter out every human weakness, but it annoyed us. Character matters, and when we got that wrong, it cost us money. We also underestimated how hard it is to change human behavior. Some companies look fixable on paper: better management, better incentives, maybe a turnaround. But corporate culture isn't easily changed. If the DNA is rotten, new wallpaper won't help. We learned that the hard way, and yes, we missed opportunities. People think Berkshire caught everything good. Wrong. We walked past things that, in hindsight, would have been spectacular. Tech companies, for example. Warren admitted he didn't understand them well enough. Neither did I. In that sense, our caution cost us lost profits. But I will tell you this: I would rather miss a profit than blow up chasing something I don't understand. That caution may have cost us billions, but it saved us from disasters that would have cost more. Our greatest strength was knowing the limits of our knowledge. Most investors don't have that. They want to be experts in everything. We didn't. We stuck to our circle of competence. If it was outside that, we simply said no. That one simple habit explains most of Berkshire's longevity. If you are over 50, you should think about partnerships the way we did. Ask yourself, does this person make me more rational or less? Do they bring stability or drama? Do they amplify my strengths or magnify my weaknesses? The wrong partner can destroy a decade of work. The right one can multiply it. In the end, what worked between Warren and me wasn't genius. It was compatibility. And what didn't work were the rare moments when we forgot our own rules. So don't mythologize us. We weren't gods. We were just two stubborn men who shared one brain when it came to money. And that was enough. Here is what most people don't want to hear. Getting rich after 50 isn't so much about making brilliant moves as it is about avoiding fatal ones. At this age, survival is the strategy. You can still create wealth after 50. I have seen many do it, but they didn't do it by chasing hot tips or trading like 20-year-olds. They did it by being boring, stable, and ruthlessly rational. The surprising truth is this: you don't need to double your money overnight. You just need not to blow yourself up. Let me give you an example. I knew a doctor with a good income, sensible in spending. At 55, he started directing his savings into a basket of high-quality dividend stocks. He ignored the noise, reinvested dividends, lived within his means. By 70, he wasn't fabulously rich, but he was financially free. No debt, plenty of income, comfort, security. Now compare that to another man I knew, a sharp entrepreneur who thought he was behind. At 52, he dumped his savings into speculative real estate deals, leveraged to the hilt. When the market turned, he was bankrupt by 57. The difference wasn't brains, it was discipline. Here is the paradox. At 50, you don't need genius to win. You just need to stop doing stupid things. And believe me, the world offers you an endless buffet of stupidities. Crypto scams, day trading fads, exotic real estate schemes. The list never ends. If you want to get rich or stay rich after 50, here is the rule. Keep it simple. Own businesses or assets you actually understand. If you can't explain it to your spouse in 1 minute, you probably shouldn't own it. Preserve capital. Every dollar you lose at 60 is far more expensive than every dollar lost at 30. You don't have decades to recover. Avoid envy. Don't look at the guy who doubled his money on some risky bet. Most of the time, he won't keep it. Your job isn't to keep up with anyone. It is to stay standing. Play defense. A steady 7% compound interest over 15 years is a miracle at 50. It doubles, then doubles again. By the time you retire, you will look rich to anyone who spent those same years chasing fads. Most people over 50 forget this. You don't have to be impressive. You just have to be solvent. The world has a way of rewarding those who are durable. The truth is, I didn't plan on becoming a billionaire. I just avoided stupidity long enough for compound interest to do the heavy lifting. I overdid it. That is the game. So if you are over 50 and worried it's too late, stop panicking. You don't need to reinvent yourself. You don't need the next big thing. You need patience, simplicity, and durability. It isn't glamorous advice, but it is the only advice that works. If you want one blunt truth to end on, here it is. If you don't spend less than you earn, no one can help you. Not me, not Warren, not the smartest financial advisor on the planet. The laws of arithmetic don't care about your feelings. They don't care about your lifestyle. They don't care about your excuses. If more money flows out than flows in, the end result is guaranteed. You go broke. I have seen people with six-figure incomes live like paupers in old age because they couldn't resist spending everything they made. And I have seen people with modest earnings die in comfort because they lived simply and invested constantly. It isn't intelligence. It isn't opportunity. It is behavior. Overspending is the fastest way to destroy any investment plan. It doesn't matter if you are 25 or 65. If you keep digging the hole deeper, compound interest works against you, not for you. People ask me all the time, "Charlie, what's the best investment at my age?" My answer is usually, stop buying shit you don't need. That one piece of advice would solve half the financial misery in the world. At age 50 plus, the consequences are sharper. You can't make endless mistakes. You can't start over every decade. Your choices either prepare you for a dignified retirement or condemn you to dependence on others. The goal at this stage isn't glamour, isn't chasing the biggest return. It is dignity. It is independence. It is knowing you won't have to beg your children for money or work until you drop dead. And that doesn't come from clever deals. It comes from restraint. If you eliminate debt, avoid drama, ignore stupid people, and live within your means, you have already beaten 90% of humanity in the money game. Do that long enough, and compound interest will take care of the rest. But if you overspend, forget it. No one can save you, not even the stock market gods. So here is my final question. When you are 70, do you want to envy your neighbor's toys or enjoy your own freedom? The choice is obvious. Execution is rare. Remember, the world doesn't reward genius as much as it rewards avoiding stupidity. And there is nothing stupider than spending yourself into misery. That's it.